The biggest expense you have is not your mortgage, your car, or your children. It is the invisible friction of tax liability. For most people, it's a silent drain. But for a select group of investors, it's a game, a set of rules they've mastered. Welcome to the Reserve Ledger. Since the permanent extension of the OBBB Act, the landscape of American wealth has fundamentally changed. The goal is no longer growth. The goal is efficiency. The top 1% aren't hiding their money. They are using the laws Congress wrote to build a fortress, a shield. We've spent months conducting an internal audit of the most powerful legal loopholes. In today's briefing, we unlock the Reserve Ledger. 3 pillars of autonomous, tax-free wealth: municipal anchors, phantom depreciation, and the art of the harvest. The first pillar is the Municipal Bond, or the Muni. Sounds boring, right? That's the point. It's what your grandfather would buy. It's also what the wealthy use as their economic anchor. When a city needs to build a school or a highway, they don't go to a bank. They borrow from the public. In exchange for your loan, the city pays you interest. But Section 103 of the Internal Revenue Code holds a secret. That interest is generally tax-free. For a high-income earner in New York or California, a 5.5% taxable yield is closer to 3.8% after taxes. But a 5.5% double tax-free muni yield, it stays 5.5%. Mathematically, for a top-bracket earner, that is equivalent to earning over 9% implied. The 1% doesn't chase risk. They chase efficiency. How do they buy them? The elite use private desks. But for you, the key is municipal bond ETFs. Look for funds offered by Vanguard or Fidelity that are specifically double tax-free for your state. Your cash isn't just sitting, it's anchoring your tax-free reserve. If Muni bonds are the shield, real estate is the eraser. The wealthy use property not for rental income, but to generate a powerful accounting mechanism called depreciation. Depreciation assumes buildings fall apart over time. For an apartment complex, it's 27.5 years. This means an investor can collect $100,000 in cold, hard rental profit, but tell the IRS they lost money because the building depreciated. We call this the phantom loss. In 2026, the OBBB Act amplified this. Accelerated or bonus depreciation allows you to sometimes claim decades of wear and tear, carpets, appliances, and fixtures, in a single tax season. The result? Legally zeroing out massive property income and taking paper losses. They live in luxury on buildings that are legally considered losses. This is the internal audit of their autonomous wealth structure. Wealth is a magnet for litigation. This is where the shield becomes a fortress. The elite do not own assets. Their trusts do. Specifically, irrevocable domestic asset protection trusts. High net worth individuals establish these in states like South Dakota or Nevada. By moving their assets, their property, their stocks, their art, into these structures, they become effectively judgment-proof. You can sue them for millions, but on paper, they own nothing but the suit on their back. They have no wealth to be taxed. Their Reserve Ledger Trust is their autonomous tax-exempt entity that buys their properties, pays for their cars, and grows their family empire, all while legally broke. The ultimate goal is legacy. The Dynasty Protocol. The OBBB Act has given the 1% a gift, an astonishing $15 million estate tax exemption per person. That's a massive $30 million for a couple to pass down tax-free. They aren't waiting until they die. They are gifting their future appreciation now, locking in these high exemption limits before they sunset. They use advanced mechanisms like GRATs and IDGTs to pass the gains of their assets down, completely bypassing the tax friction. They aren't just building a bank account, they are constructing a 100-year shield that ensures their wealth outlives them, tax-free. But how do you maintain a fortress during a crash? You harvest. Tax loss, harvesting. When the amateur sees a market crash and panics, the professional sees a tax credit. In 2026, you cannot simply sell a stock for a loss and rebuy the same asset. The IRS Sentinel AI will flag the trade and disqualify the shield. But for those who master the 31-day wash sale window, a market crash is just a massive credit waiting to be activated. The shield is not for everyone. It requires data, discipline, and a different way of seeing the world. The question isn't whether you'll pay taxes, it's whether you'll play the game or be played by it. Join the community. Keep your shield strong. This is the Reserve Ledger.